90.3 WHPC now presents Law You Should Know. The law affects every aspect of our lives, our home, our jobs, and our recreational activities. Now, learn about the law and how to protect yourself against the loss of your liberty or property, and learn how to stand up for your rights and seek compensation when you have been wronged. Your host for Law You Should Know is attorney Kenneth J. Landau, a past dean of the Nassau Academy of Law, and frequently lectures to lawyers on ethics and avoiding problems with clients, and to the public on how to choose and use lawyers. This is Law You Should Know on the voice of Nassau Community College, 90.3 WHPC.
Hi, this is Ken Landau, and welcome to Law You Should Know. Today we're going to discuss year-end tax tips, things an individual, a partnership, a small business, or even a larger corporation can do to minimize their tax liability for 2023 and perhaps 2024 as well. Our special guest is Seth L Starr. He's a founding partner with the accounting firm of Frankel, Loughran, Starr, and Vallone, with offices in Garden City, Long Island, but they handle clients all around the metropolitan area. Seth, welcome to Law You Should Know.
Thank you, Ken. Thanks for having me here.
We just want to give people ideas on what they can and should try to do before December 31st, or what to do early in 2024, just to put themselves in the best possible position tax-wise for 2023, 2024, and going forward. And, some of the important stuff changes every year, so thank you for doing this show.
Of course.
What are some general considerations as someone's thinking about their taxes, trying to minimize their taxes for 2023, perhaps 2024 and beyond, or what kind of steps should they take?
Sure. Well, individuals are what you call cash basis taxpayers, which means that when they receive cash, they generally pay taxes on it. And when they lay out cash, pay a bill, they get a deduction for it. So one easy thing for cash basis taxpayers, especially small business owners, is to try to defer collecting revenues, sending out bills, sending out receivables before the end of the year to try to lower the amount of income to be recognized during the year.
So they'll be in a lower tax bracket for 2023.
Right, yeah, and that's a great point. There's 7 different tax brackets, and what you want to try to do is be in the lowest bracket possible.
And so you can defer income if you're able to do that. And should you accelerate expenses, pay off your bills due now in 2023 so you can take them as a deduction in 2023?
Yeah, no, absolutely. I mean, so the other side is to pay expenses. If you have a bill, if you have a business, you want to pay off vendors, pay those before the end of the year. If you're an individual subject to certain limitations, it's good to prepay your real estate taxes before the end of the year. Make charitable contributions before the end of the year. And, charitable contributions can either be done in cash, or if you have stock with a low basis that you held for more than a year, you can actually donate appreciated stock and avoid the capital gains on it. The other thing is perhaps prepaying medical expenses, which can be deductible in certain circumstances if they exceed 7.5% of your income.
And so with the 7.5%, if you're getting close, you want to accelerate, let's say, those expenses, or if you think next year you may be better at meeting it, perhaps you want to kick them over the next year.
Exactly. Well, what happens with an individual taxpayer is they get the higher of either a standard deduction or their actual itemized deductions that they pay in the year. The standard deduction in 2023 for a joint taxpayer is $27,700. For an individual, it's $13,850. So what you do is you tabulate, do you have itemized deductions that are greater than the standard deduction? If so, you'll take those. So you might get above the threshold of the standard deduction if you pay more than 1 year's worth of expenses in 1 year so that you can take advantage of that higher amount. And what are itemized deductions? Typically, they're medical expenses if they exceed 7.5% of your income. They're charitable deductions. They're your mortgage interest. And they're your state and local and real estate taxes, which I'll talk about a little bit later. Those are limited as well.
And they may cover tuition if it's for above the basic knowledge, if you're going for a special seminar to bring you up to date or teach you an additional skill.
Well, that's a good question. So educational expenses, if they are, as you said, teach you, if they're just minimum for your job, you can't deduct them. But if they teach you a new skill, you may be able to deduct them depending on whether you're an employee or an independent contractor.
And the master's or special skill, you would you'd want to pay them or perhaps kick them over till next year if you're going to have more income and you need more deductions for next year.
Exactly. So you got to do the tabulation to take a look at that.
Let's talk about people who are independent contractors.
Okay.
What are some of their concerns for income and deductions?
Well, an independent contractor is a little bit different because they have to pay not only income taxes, but self-employment taxes. If you're an employee, you see it as FICA, which is Social Security tax. But if you're an independent contractor, you have to basically pay both halves. If you're an employee, you pay half of the Social Security tax. The employer pays the other half. If you're an independent contractor, you have to pay both halves. So that's another tax above the regular income tax rates. However, if you're an independent contractor, you can deduct all your expenses against your income, which you normally can't do if you're an employee. And they would include, as you were talking about, certain types of special educational expenses, business meals if they're related to a business, any expenses related to
maybe
your
rent, maybe your computer, maybe your car, if it's necessary for the business.
Exactly. Well, if you don't have a separate office and you're working from home and you have a separate structure that's set up just as a home office, you can deduct those expenses. You basically do a calculation based on the square feet of the home, and what percentage is business. You could take that percentage against all your normal home expenses.
Now, in this world of the gig economy, this is more common than ever. So lawyers may be freelancers. They may be working part-time. They may be working for different employees, graphic artists, accountants, all kinds of experts, computer. It's a whole different world out there. From the individuals, the workers' perspective, when are they better off being a freelancer? Sometimes they don't have a choice, but sometimes they could be a part-time employee, so to speak, if they have a choice. Is there any advantage to them or for the employer?
Well, it's a trade-off, Ken. On the one hand, as I said, you can take expenses when you're an independent contractor, but you do have to pay more Social Security tax. On the other hand, sometimes people want to be an employee because they want to be covered by health insurance plans, by retirement plans,
maybe workers' comp
plans, and other things. It takes away some of that risk. But on the other hand, an independent contractor, as you said, that might be kind of encouraged that you have to do it that way. And that's why you really want to take as many expenses and set up your own health insurance plan. And one thing I should mention is if you're self-employed, you can deduct your health insurance premiums, expenses up to your income, whereas an employee, then it just becomes a medical expense, and unless it exceeds 75% of your income, you can't deduct that.
So there are different strategies, and you really should go over it carefully with an accountant. And they could be both. They could be an employee to someone 2 days a week and a freelancer to other employers, or maybe the same employer 2 days a week.
Exactly. And that's happened, I think, a lot from COVID with people working from home or whatever. A lot of people now, see these kind of what I call hybrid situations.
And even layoffs or retirements that you get laid off, but they find they need you, or maybe you retire and they need you to come in on an occasional basis or do special projects.
Exactly. It's happening more and more.
And you've got to price your services so you have enough to cover your expense and your health insurance and the other taxes you mentioned.
Right. Yeah. And I think when people are going back to think about maybe working after they've retired or they were laid off and they were going to take an early retirement, they have to make sure that it's worth their while after taxes to even take on that type of work.
And if they have a lot of deductions, it may help to lower their tax bracket or qualify for Social Security, not lose it, because if that's at some age, Social Security may be in the mix, or a pension or something.
Right. Those are exactly the kind of things that a quality accounting firm or a CPA should be looking at for their clients and kind of running the numbers.
And if you have a choice, and sometimes you don't have a choice, you just try to maximize your situation.
Right, exactly. And one thing to add too is retirement plans, that if you're self-employed and you have a lot of, a significant amount of income, you could do more than the normal retirement plan that you could do at work, where you do a 401k and it's kind of limited. $22,500 is the number for 2023. And if you're over age 50, it's $30,000. If you're self-employed, you could set up what they call a SEP plan, and you can actually deduct up to $66,000.
If you have the income to make those contributions.
Right.
But sometimes that might get you in a lower tax bracket. So if you've had a good year or you've gotten bonuses, your income's going up, it's something to think about. And the deadline on doing those things is sometime next year?
Well, okay, another great question. For a SEP plan, which is a great plan for self-employed, you have to establish the plan before December 31st. You put $100 in, just have it set up, and then you have until you file your tax return, and you actually, even if you go an extension, you have later to actually fund that. So there's timing of when you could do retirement plans. An IRA, which is something I think you mentioned, year planning after the end of the year, an IRA can be contributed to for the previous year as long as it's done by April 15th. But a self-employed retirement plan, the SEP plan that I mentioned, you have a later date than that.
So if you have the extra income or it helps reduce your tax bracket, it's good to think about.
Absolutely, yep.
Any other tips for employees versus employers? Or as you said, you might want to defer a bonus if you're the employee, unless you want to take it now or for some reason. And employers want to accelerate deductions or expenses if they want to. Exactly. Yeah, no. And, we have clients, one of the things I want to mention because it's so important is that there's a lot of things in the tax law right now that are going to be expiring at the end of 2025. When the Tax Cuts Act was put in 2017, it was put in for 8 years and things sunset. And the reason they sunset is that Congress couldn't get 60 out of 100 senators to vote on it. So so because of that, it's only temporarily. It's 8 years. And one of the big problems that a lot of people in New York have is the fact that they can only deduct $10,000 in real estate taxes and state and local taxes. They call it the SALT deduction, and that really affects people in Long Island because the real estate taxes are so high. That expires at the end of 2025, but people who have their own business can institute something called a PTET, a pass-through entity tax, where they can pay those taxes, their state taxes, at the business level, pass it down to the individual, and actually deduct more. So just to clarify, as it stands now, after 2025, people will be able to take off more of their real estate taxes?
Yes. Unless and I guess a lot of that will be determined in the presidential election next year. But I think if the Democrats control the Senate, then I think that they will have enough votes. I would guess that they'll try to reinstitute it, especially the senators in New York and New Jersey and Massachusetts will want to make that go back to the old rules.
Of course, that expands the deficit and makes the country go further underwater
because
they won't be getting that income.
That's a trade-off.
But that's been a burden on many people, even middle-class people, so that may go away after 2025.
It will go away after 2025 unless they pass new legislation to extend
and
it.
Local taxes may go up to make up for it.
Still be some trade-off.
Okay, just a reminder, listeners, you're listening to Law You Should Know here on 90.3 WHPC, the voice of Nassau Community College. We're talking about year-end tax tips, things you can do in December of 2023 or early in 2024 to maximize or minimize the tax consequences for this year. Our guest is Seth L Starr, and he is a partner with the firm of Frankel, Loughran, Starr, and Vallone, with offices in Garden City and around the New York area. So, Seth, what are some other things in terms of planning? People thinking of buying a computer, especially if they're a freelancer, buying a new car, especially if they're a freelancer, as you mentioned, and they have the income and they want the write-off. These are things they should try to do now.
Yeah, no, absolutely. On the business level, take so much of of what's important and what we try to really get our clients to think about is keeping contemporaneous records. As you go along during the year, record. You go out to lunch. You go out to Staples. You buy things or whatever. And ideally, if you're your own business owner, you can have your own business credit card to take a tally of all your expenses. So you want to make sure that you're keeping up with things and not forgetting expenses, during the year. And that's a big part of it. So on the business side, as long as you can try to justify your expenses, you want to be able to want to make sure that you deduct all the ones that you're entitled to.
And in a more complicated financial situations, and I'm sure you have many of those clients who consult with you, what are some other things they should do to, minimize their taxes for this year and for next year and going forward?
Well, I work mostly on the individual side, and a lot of our individual clients are taking advantage of purchasing things like electric cars and taking advantage of energy credits they can get. And it's very important for our listeners to understand the difference between a deduction and a credit. If I have $1,000 of charitable contributions and I make that payment, and I'm in a 25% bracket, I'll get a 25% deduction, and that'll save me $250 in taxes. A credit is something that offsets your taxes dollar for dollar. So it's 100%, like 100% tax versus just your tax rate as the deduction. So, to encourage, kind of good climate in the country, they've instituted several tax credits, and one is the electric cars, the Teslas and other makes that manufacturers that make them. And if you get a new car that's electric in 2023, you can get up to a $7,500 credit. And they actually also instituted a credit for electric cars that are used that could be $4,000. And assuming that you have the right model and you don't have excessive income, you could take that credit to offset your deduction, your taxes dollar for dollar. That's the electric cars. There's also an energy credit, which allows you up to $3,200 of credits for doing things that lower the cost of your energy in your home, like heat pumps, insulation, special doors and windows. And there's also, even better, a 30% credit on the cost of clean energy equipment, like doing things like solar rooftops and wind energy and geothermal. If you really soup up your house to take advantage of other types of clean energy mechanisms, you can take a credit unlimited by your income of 30% of those expenses.
And the important thing is to sign up for it now, even if the work is not done in 2023.
Well, technically, it's really when, for the car, obviously, you have to get title. And for the other things, there has to be, if you're getting solar panels on your home, technically, you can't just sign up for it. It has to be, in place and working for you to take credit. That determines what tax year you get that credit.
Okay, but you could buy some of those, let's say appliance or a heating system and perhaps get it installed.
Yes, exactly.
And some of these electric car things, there also may be sunset provisions?
No, right now I think that, there was for a while, but I think right now they're in place, I'm pretty sure, until 2032. So it just depends, though, on the manufacturer. You really have to go to the dealer, and you have to make sure that they, tell you that you're going to get a credit for it. And then, honestly, I would just kind of Google it and make sure that the dealers who are very aggressive in trying to sell you cars are telling you the truth, that what you're buying really qualifies for that credit.
Okay. And what are some other things, as someone is in December of 2023 or early in the year, what are some other things they can think about or do as far as planning goes?
Well, we get involved a lot with our taxpayers when it comes to capital gains and losses. So if somebody has capital gains that they've realized during the year, they can speak to their broker and to their accountant and try to generate capital losses before the end of the year to offset them. On the flip side, if they have capital losses already, they can actually try to maybe bring in some capital gains into the year. You want to kind of try to get those to kind of wash themselves out if you can. So that's something that we work closely with our clients and their investment brokers on that.
And what kind of capital losses could there be? Like a stock that's gone down, a piece of real estate that maybe has depreciated?
Exactly. Stock, real estate, a lot of clients now are investing, and they have losses in the crypto world. So you want to, just because you have a loss in your portfolio doesn't mean you get a capital loss. You have to realize it. You have to go to and actually sell it. On the flip side, if you have a big gain, you don't pay taxes on the gain the way the law is until you realize it. It works the same for losses.
And if you've been a crime victim, sometimes you can deduct the loss?
I haven't worked with taxpayers in that situation.
Okay. Well, if your home got robbed
yes. You're talking about casualty losses.
Casualty losses
used to be something that was in the tax law.
And that would be a hurricane or
right. Now it has to be.
Yeah.
It used to be that you just had something happen badly, you could deduct it. Now it has to be a national disaster declared by the government to allow you to get the casualty loss.
We mentioned it briefly before, but tuition, you could try to pay it, the spring tuition or part of it by December 31st and take that deduction if it was going to help you?
Yeah, well, yes, but when would it help you? It would help you if you want to they have educational credits as well that come in for people that are in a 4-year college or go back to school for an advanced classes. they can get an educational credit as well, subject to limitations for high net worth, high income taxpayers. And also 529 plans for education is something that's very big for our clients where, their children or their grandchildren, they want to put money away and they want the money to grow tax free. They set up a 529 plan, which is, issued by every single state, has their own state 529 plan. You put the money away and the money will grow tax free as long as on the back end it's used by somebody for their education. And if you do the New York plan, you actually can get up to a $10,000 deduction if you file jointly by putting money into the New York 529 plan.
And that should be done before the first birthday.
Yes. Well, I've seen people that have done it even almost before and just changed the beneficiary. But yeah.
And what about kids earning income? Some kids have businesses or work a summer.
Right.
Is that part of the parents' income and tax situation, or the kids file their own form and maybe they have a business loss too?
Okay, yeah. Well, there's a couple of things. If it's unearned income and it's over $2,500 and the child is still basically a minor, then there's something called the kiddie tax. In the old days, people would just throw money into their children and just let it grow because they were in very lower tax brackets. Now they have something called the kiddie tax that in 2023, if it's over $2,500 of unearned income, is taxed as the parent's rate. That's unearned income. But we were talking about business owners. Another good planning idea is perhaps employing your children into the business and getting a deduction for their salary and having them pick up income, which would be at a lower bracket because the kiddie tax doesn't apply to earned income, only to investment income.
And this is if they're really working for you.
Yes.
I would just like to remind our listeners, we're talking about year-end tax tips. Our special guest is Seth L Starr. He's a CPA and the founding partner of Frankel, Loughran, Starr, and Vallone, with offices in Garden City and elsewhere in New York, and he has clients all over the New York metropolitan area. You're listening to Law You Should Know here on 90.3 WHPC. And if you missed any portion of this program or you want to tell someone else about it, just go to the podcast at nccradio.org. And, of course, there are many other podcasts there about law or business topics. Seth, what are some you mentioned the 529. Anything else that a family or a professional should do to minimize his tax liability and enhance his or her financial well-being?
Well, one thing that's a big area for our clients is taking their IRAs and converting them into Roth IRAs. So basically, if you have an IRA and you decide to make it into a Roth, you'll pay taxes now on the amount, the value in the IRA. And it's ideal if you have a year with you're in a low tax bracket. But later, so let's say you put $50,000 from a regular IRA into a Roth, you pay taxes now on the $50,000, but now all the growth on that Roth from now and forever is never taxed. And additionally, you don't have to take out minimum distributions. It's important to mention that people over age 72 with a retirement account have to take out required minimum distributions before the end of the year, which is a percentage of their retirement account value.
And roughly what percentage is it?
It depends on the beneficiaries and other things, but it's not a big number. If it's 72 and, it could be 4 or 5% of the account balance on the previous year. And
if you didn't convert it to a Roth, which I know is the thinking now, as you can still take some out, but you might want to not take out too much because then you'd be a high earner. Right. Well, and that's why some people take it out. You can actually start taking it out when you're 59 and a half, but you have to take it out now in age 72. It used to be 70 and a half, and sometimes people take it out earlier to spread out the income and to keep the brackets the same. Okay. And about what income, how much can you take out, let's say in numbers or it depends on your other income as well? Yeah, it depends on your other income. You really need to do a tax projection. And as I said, the rates go from like 10% to 37%. So you really need to kind of look at that. So you want to take it out during the 10% years? Ideally, yes. Can you give us your website, Seth, where people can get more information about your firm and more information about taxes and other things? Sure. Yeah, no. So again, I'm Seth Starr, and our firm website is FLSV, which is for Frankel, Loughran, Starr, and Vallone
.com. We're based in Garden City, and we also have an office. Actually, we've had a lot of clients who moved down to Florida, which is probably another conversation. But you could save taxes moving to a lower tax jurisdiction like Florida,
and working from there. You don't have to wait till you retire.
Yes. And so we have an office as well in West Palm Beach, and
I know that's a complicated area, but if you do that, you want to avoid residency triggers. So you really have to physically be out of New York for more than half the year?
You have to physically be. That's exactly. There's two tests. There's a statutory test, which is counting your days, and people have apps that actually count where they are.
And the government is spying on you,
the government is looking at New York. We have knock on wood, we have very few IRS audits. We have a lot of state audits, especially in New York State. But the other thing is, besides just not being here 183 days, you have to change your domicile, you have to ship your family goods, change your wills, change your driver's license, etc., to show that, everything near and dear in your life is now outside of New York.
So it's time plus property.
Plus property and plus other, factors.
It's hard to see Broadway. Are there any downsides to moving to Florida?
Well, honestly,
it's hot sometimes.
Yes. Well, again, it's a trade-off. Honestly, we have clients who are fighting. If the spouses have a disagreement, if they have grandchildren, they don't want to leave them and just save taxes and stuff. So, sometimes I'll tell my clients, look, you've worked so hard to set up your life so much. Do you really want to change your lifestyle just to save taxes? So that would be the trade-off. To leave.
But at some point, you might want to do it, especially if you're closer to, say, retirement, and you go to Florida and you have retirement down there.
Yeah, exactly.
And the other flip is you can't claim a homeowner a deduction or exemption in New York if your residence is in Florida.
That's an excellent.
Well, you just got to be careful with that.
That's an excellent question, Ken. I actually have a client now who's moving down there, and they found out that if they claim homestead, which means they're basically putting their, the line in the sand, I'm a Florida resident, their real estate taxes went down about 70% because they've said Florida is their permanent place. So
but if they have if they own property in New York and they're getting homeowner exemptions or deductions, they may lose that.
They would lose those because New York is now not their primary residence, which you need for those.
Seth, any final thoughts on do's and don'ts for year-end tax planning or things people should think about in 2024 and beyond?
No, I think it's important to be looking forward on things, following the laws. I think also one thing that's been a big thing over the years is clients now file a lot of times electronically. A lot of my clients initially were afraid of that because they thought identity theft and things would be a problem. But I can tell you that it hasn't been a problem, and that allows you to get your refunds and things a lot quicker. There's also, one thing to add too, is that there's very helpful sites that are out there by the IRS and New York State. IRS.gov is the IRS site, and New York State site is tax.ny.gov. tax.my.gov. And those sites basically will give you your tax record, your refund status. You can check on your withholding. They can answer questions, and you might know the IRS has put a lot more money into staffing to answer these questions. You can get forms. You can check on notices, etc.
But in general, you should never give your social security number or even your date of birth or too much information over the phone by someone who claims they're calling from the IRS.
Well, I get that all the time, yes. Ken. The IRS never calls you. And if you have anything suspicious, if you could just Google it, you probably see that that's part of a whole scam.
But they're never going to call you. So never give your social security number or any personal information and your date of birth, maybe not even your address, to anyone over the phone.
When we file electronically, we actually redact all the numbers in the Social Security number except for the last four.
Okay, and your own website is flsv.com.
Right.
I would like to thank CPA Seth L Starr, and as you've heard, he's one of the partners with Frankel, Loughran, Starr, and Vallone, with offices in Garden City and in Florida. Keep in mind, whatever you've heard is presented as information only. You must get tax and legal advice from your own qualified professional. If you missed any part of this broadcast, just go to the WHPC website at nccradio.org. And there are many other programs about law and all kinds of other interesting topics at nccradio.org. And please join us next week, this same time on 90.3 WHPC, the voice of Nassau Community College, for another program on law you should know.